Everybody, Ed Yardeni here. As you can see, we've have a winter wonderland behind me in Long Island. It's actually a photo of the upstairs balcony, so you can see we had something like over a foot of snow. I did not trip when I went out to clean up the snow, which is what you may be wondering. I'm wearing this neck brace. Actually, I don't have any problem whatsoever. I've been just trying it on. Just to show you what you should order from Amazon or CVS to deal with the market. Extraordinary volatility, and it's been getting my neck a little bit to watch the screen way too much. For somebody who is focused on long-term investing, I look at the market much too often. But what can we do here? Well, today is January 31st. The snow is over. We got a sunny day, but it's extremely cold, so everything is iced over. So I will have to watch out when I go out there not to slip on some ice. Lots to talk about. There's the topics I want to address in the next 15, 20 minutes is valuation, earnings, sentiment in the market, the economy, and inflation, just all the usual topics. And I think I'm going to get rid of my background here. Let's see if I can do that so that we can just focus. Do that again. As you can see, I'm a real pro here with this background. There we go. Just want to get it to be normal. Okay, there we are. Here I am in my office. So too many fun things to do with Zoom. Let's get right into it. I've taken up too much of your time on silly little things. So let's share the screen and go here and look at the charts. Okay, so I was looking at them before. And let's look over here. And as you can see, in terms of valuation, clearly, the Fed is the story. We've had a lot of volatility in the market since the beginning of the year. And it's all because of what the Fed has been doing. The Fed has indicated that, well, at the end of last year, they indicated they're going to be raising short-term rates after they stop buying bonds. And they said that they would stop buying bonds now in March. Remember, that was going to be in July. But now March will be the last month that they buy bonds. So actually April will be the first month without any purchases. And then they said right after that, they're going to be raising interest rates. And then what really spooked the market is that on January 5th, there was a perception that the minutes that came out for December were strongly indicating that the Fed's going to let its balance sheet run off. So the markets have had a real nervous breakdown here, a lot of weakness, mostly because there's a perception that the Fed's overdoing it or planning to overdo it. It's been awfully indecisive. If you read the Powell's press conference transcript, and I read it, I reported on it this morning, but I'll do it again tomorrow. There were like 15 instances of Powell indicating that that the FOMC hasn't really made any decisions yet about what they want to do and when they're going to do it. I mean, he mentioned the fact that the labor market is strong. He mentioned the fact that the inflation is persistent so many times that the market came to the conclusion that as indecisive as Powell was in his press conference for the latest meeting, the March 15th meeting is going to be very decisive. And it's pretty clear they're going to announce that they're done buying bonds and that they're going to start raising the Fed funds rate. And that could be announced at the March 15th meeting. And the only controversy right now is whether it's going to be 25 or 50 basis points. So that's where we are on that. But when he was asked several times, what's the pace of increase is going to be in the Fed's fundraising, he said, we haven't made that decision yet. And when he was asked, what are you going to do about the runoff? He said, we haven't made that decision yet. So again, very just to heighten the uncertainty that the market is facing. Meanwhile, there's not much uncertainty in terms of what the two-year note yield is showing. It's showing, well, this morning it's up to 1.2. So it's definitely a good leading indicator of what the market anticipates the Fed is going to be doing up ahead here. So you can pretty much see a step function here over the rest of the year. And the only question is whether it's going to be 4 or 7 increases. 7 increases will be an increase at every meeting. And that's not likely to happen in my opinion. I think it's going to be 4, but the consensus seems to be 5 increases. The good news, I think, is the market has already discounted a lot of that. But it sure would be a good idea if the FOMC just started moving along with the program instead of hemming and hawing and hinting and having these indecisive press conferences. Meanwhile, I guess we should be concerned about the fact that as the short-term yield has gone up, the 2-year's gone up, the 10-year hasn't gone up much at all. And as you can see, when you look at the red yield curve spread here, it's actually narrowed. Why is that a concern? Well, historically, the yield curve tends to be a pretty good forecaster of a recession. My view is that's really not quite the way it works. What really happens is the yield curve anticipates that if the Fed continues to raise short-term rates, at some point something will break. There'll be a financial crisis that could become a credit crunch. That could become a recession. But it's very unusual for the yield curve to start narrowing when the Fed hasn't even done anything yet. So maybe the Fed folks are just very satisfied that by sort of just talking about it, they've accomplished quite a bit in terms of getting the markets adjusted to rate increases. And that's certainly been the case when it comes to the valuation multiples. This is the forward PEs of the S&P 500, growth, value, and the mega cap 8. And as you can see, the S&P 500 has dropped to 19.7. I was thinking, Joe and I were thinking, well, I was thinking that we'd have this thing going at 20 to 22. It's been there for a year, which is very unusual. And we thought that would continue to be the case, but clearly that's not the case. We're now below 20. Yet we think it's going to hold 19. It's kind of where it was right before the pandemic hit. Of course, back here, no one was worrying about the Fed raising interest rates and inflation. So that is a concern. But I think to a large extent, where the valuation goes is going to be predicated on what happens to the inflation rate. And I'm an optimist on the inflation side. I think within the next few months, we'll see a peak and inflation will come down pretty hard. If that's the case, that would help the market a lot. For now, we have changed our outlook for the S&P 500. Instead of talking about 5,200 by the end of this year, we think it's going to be more like 4,800, which would be unchanged for the year. And all of that is because of the Fed. When in doubt, blame the Fed. But that clearly has created some issues here in terms of the Fed's incremental approach to what they should be doing. Again, if the market is already discounted like 100 basis point Fed funds rate, a 1% Fed funds rate, if I was doing it, I just raise it a full percentage point and said, okay, that's it. For 6 months, we're going to reassess things and see how the market and the economy responds to all that. But instead, they're going to do it incrementally, and maybe they'll get bold enough to do 50 instead of 25. But clearly, the drop in the S&P 500 PE has been somewhat associated with value recently, but value is holding up pretty well around here. It's the growth that's come down a lot, and the growth's come down a lot because the mega cap 8 have come down a lot. So they're down to 29.6, still pretty expensive. But the reason they're mega cap 8 is because they are extraordinary companies able to grow earnings remarkably fast for large companies. Here's the valuation multiples for large cap, mid cap, small cap, and the mega cap 8 again. This time it's cap size instead of growth. And it's the same story. There's the mega cap. Here's the S&P 500. And I've been pointing out for a while here, maybe all too long, that the prices of the stock prices of the SMID caps, the 400 and 600, have been holding remarkably steady while the S&P 500 had rallied to an all-time record high on January 3rd of almost 4,800. Meanwhile, the earnings picture for SMID caps has been fabulous, and yet they've been stalled out. Perhaps it's because they are viewed as much more risk on and people just have been taking risk off as the Fed's become more and more an issue in terms of a U-turn from easy to tight monetary policy. I want to show you the forward earnings of growth value and the large caps and mid caps. That's where the good news really is. I mean, look at the growth forward earnings, very, very strong. Value is also strong, though with a lag. They have been moving together actually pretty well. But since the pandemic, we've seen growth maybe recovering faster, sooner, higher, but value is doing just fine. So the S&P 500 components, growth and value, the earnings look good. Now you could go back here and say, well, they always look good right before the world comes to an end, or at least we have a recession. So maybe there's, we're going to have to kind of draw a blue shade line here for the next recession. But I don't think there's going to be a recession this year or next year. And if that's the case, then these tend to be pretty good predictors of where we're in fact going. Here's the same thing, forward earnings for the large cap, which is this one right here. Looks pretty good, right? Nice V-shaped recovery, much better than the U-shaped recovery we had here. It took a while to get back to this high. Here we're already at record highs. But look at the mid caps. This is the 400, this is the 600, and they've been on fire. I mean, they've been stronger than the large caps, but like Rodney Dangerfield, they've been getting no respect for that, and they've stalled out awfully cheap. Now, here's some more good news. When we take forward earnings and forward revenues, we calculate forward profit margins, and these are very impressive. I know that during the conference calls, there were some companies like JP Morgan and Goldman Sachs saying that their costs were going up, especially labor costs. But companies seem to be doing a pretty good job of figuring out how to offset them with productivity, and some of them are obviously increasing prices. But look at this profit margin for the large caps. That's still making record highs. And it tends to be a pretty good coincident indicator of the actual quarterly data. So I'm impressed by that. And then, of course, we have similar kind of patterns, particularly the S&P 600's remarkably strong. This may be stalling out, but we'll see how that plays out. Again, forward profit margins, let's look at growth versus value. The growth straight up, and the value is at a record high. Well, it's not quite at a record high. It's almost back to where it had been. But growth certainly continues to surpass any highs before. And I think that's one of the reasons that growth tends to have a high valuation multiple. Let's talk about sentiment quickly here. Sentiment has turned increasingly bearish. I thought that the January 25th data would come in around 1.0, given how bad things felt during the correction or capitulation Monday that we had a week ago. I really think that was the low for this correction, for this sell-off. That would be 4229 on the S&P 500. Why one? Well, one, historically, whenever we're at one or below, that's been a remarkably good signal to buy the market. We're close enough, in my opinion, but maybe not close enough to get out of this volatile period. So we're at least good for this rebound from the Monday a week ago low. And you can see that bearish sentiment has been picking up. But the reason that we haven't had more bearish sentiment is some of the bulls jumped into the correction camp, which of course is what we've sort of experienced. But ever since they've done that, the market seems to be doing somewhat better, but can't ignore the volatility. Well, how about the volatility, folks? Let's talk about it. You can see here the VIX versus the bear bull ratio. Turns out that when you flip the bull bear ratio upside down, it's pretty well correlated with the S&P 500 VIX, though you may need a neck brace to monitor it on a daily basis. But as you can see, they're both pretty volatile, and we have seen the bear bull ratio increase, and we've seen the VIX increase. But I've also put in shades for bear markets and for corrections, and we're not in bear market territory. We're still more in correction territory. We're not in recession territory. Here's another slice and dice of the same chart versus recession shades. We're not in recession territory in this stuff. I'll have to admit to you that this is not exactly giving you a lot of warning, these signals. They tend to be pretty coincident, but at least they give you some indication of what everybody else is thinking. But this is where I want to show you an interesting chart. This shows you the VIX versus the high yield corporate bond spread. And again, very highly correlated. And what I like about this is, yeah, we got a correction going on. We got the VIX up, but the high yield corporate spread between the junk bonds and the govies remains extremely low. So we're not getting a flash signal here that these whatever problems the market's worrying about, particularly the Fed doing a U-turn. So far, the corporate bond market isn't signaling that they're making a huge mistake and it's going to lead to an imminent recession. So that's something to keep in mind. And again, if we are heading towards a recession soon, we'll be then the correction will be a bear market, but that's not my perception. So again, here it was that spread versus the recessions, and here, just for your enjoyment, is the same spread versus bear markets and corrections. Obviously, Joe and I are going to have to add a correction shade here. We just want to get more confirmation that Monday was the low, and that should be the end of it. So we'll see how that goes in the next couple of days, few weeks. We created a risk proxy based on the VIX and the credit yield spread, as you can see in this chart. You can read about it in the morning briefing, but again, it's not signaling the kind of troubles that we had at this point, or even in some of the previous corrections. But maybe it's still early on here. The Fed hasn't actually started tightening, so we'll see how that plays out. Meanwhile, I think the big concern about the Fed has been the runoff that they started to signal us in the December 15th minutes that got released on January 5th. And there's $1.4 trillion. Let's see, let's go over here, 1 year or less, $1.14 trillion in the 1 year or less securities. And those presumably are the ones that they would let run off. And I think the market got kind of spooked that they would actually do this on a monthly basis, 12 divided into 1.1 trillion, and realizes that that's a heck of a lot that the Treasury market would have to absorb, in addition to the fact that the Fed would no longer be buying $80 billion per month in Treasuries. But they're going to definitely have to phase that in. It's just not going to happen at that monthly pace. So here we are with the bond market still remaining under 2%. Should have been already at 2.5%, given what inflation is doing, given all the signaling by the Fed that they're going to be tightening. But maybe it's because the Fed has still actually been buying securities. As we documented in the morning briefing, January, they were still buying tens of billions of dollars of both treasuries and mortgage-backed securities. So I don't know what they're doing. They should have been tapering faster, but they're going to stop. And when they stop, maybe that's when the bond yield goes to 2.5%. And that's maybe after a run up here. We have another sell-off, maybe retest those lows back in Monday of last week. But clearly, this volatility isn't going to go away anytime soon. I mean, nothing is completely clear here, but it seems to me that the volatility isn't going to go away soon when the Fed is being indecisive and being so coy about, what they're actually going to be doing. Maybe they don't know themselves, and they really want to get some more data to see what they're going to do, and they're going to play it by ear, which is the way they've been playing it for a while. So again, when you look at this chart, it's hard to see that they've actually been cutting back on their purchases. But soon, oh, by the way, we can look back here for the previous tapering of their balance sheet. And I did that analysis last week with Melissa, and concluded that you can't conclude a lot about what this implies for stock market or the bond market. So you have to forecast, which is what I do for a living. Economy. Let me breeze through this a little faster so we can have some discussion. So here, the economy is slowing on the consumer side. We've had very solid increases in personal income and in personal spending, but adjusted for inflation, that's not the case. You can see goods inflation, goods spending adjusted for inflation has started to stall. Now, I gotta believe we're gonna go back to the trend here. A lot of pent-up demand has been satisfied here. Maybe with the epidemic backing off now, we'll see more spending on services. There's certainly a lot of pent-up demand for autos that'll keep the economy going once we see more autos. Auto inventories actually increased in the fourth quarter. So maybe they're starting to build these things. So I don't know if you finish a truck, but you can't sell it because there's a semiconductor missing, and you park it in the St. Louis Speedway, which is where Ford's parked a lot of its trucks, light trucks. I don't know if I guess that's got to count as inventory. So it's not necessarily ready to be shipped out and sold, but there's a tremendous amount of pent-up demand for cars, and inventories, generally speaking, did build up in the fourth quarter. I think they continue to build up. But by the way, tricky thing here is if they build up less than the fourth quarter, that's actually going to be a negative for first quarter real GDP growth. So fourth quarter really felt like an inflationary boom. First quarter may feel more like stagflation with much weaker growth with still plenty of inflation. And the question is, what is going to be the theme for this year? And I think it's going to be something like slower growth, 2.5%, 3% real GDP growth, with inflation still troublesome for the next couple of months, but then peaking maybe in the spring and on its way down to maybe 3 to 4% by the end of the year. And I think the market could get enough joy out of that to keep the forward PE around 19 on the S&P 500. But that's been kind of the weak spot in our forecast is maybe been too optimistic about the valuation multiple. And that's really because there's about $3 trillion of excess M2 in the system. So if that excess liquidity is really there, as I think it is, the data shows it, and we get some moderation in inflation, we should get this market going back to record highs after it stalls out for a while longer. Orders, capital goods order, capital spending is absolutely on fire. Makes sense. We've been talking about a shortage of labor that is chronic. It's structural, and so companies have to spend on equipment, on technology to move things along. Somebody told me that Blackrock in their conference call said that their portfolio of technology of companies were spending 20% more on technology this year than the year before. So we like energy, we like financials, and we like these beat up technology names, especially the ones with earnings. Inflation is going to be the key here, and we really are focused on the durable goods orders inflation, durable goods consumer inflation. And you can see here the PCED was 10.5% in December on a year-over-year basis. Used car prices are up 50% on a year-over-year basis through December, and new car prices are up 12%. So that's a big part of the inflation problem. I'm not telling you that there aren't other problems. You can see well, we know that food and energy have been a problem. Non-durables, you can see that food and energy and some of the other non-durables are certainly troublesome, but they're volatile and they can go back down. Durable goods tend to be deflationary in the past. So I don't think this is going to just keep going straight up like this. I think it's going to start rolling over and coming down pretty hard. And then services will be another area where inflation will be a problem because of the rent component with a lag reflecting what's going on with home prices. So we covered a lot. Let me wet my whistle and let me look at the, if you have questions, don't go on the chat line, go on the Q&A. And I will have a look right now at the Q&A. Let's see. Many indicators, this is Willem, many indicators suggest that the US labor market is tight, yet real wage growth continues to be negative. Are workers underestimating price inflation? What is going on? Very good question. I think we are seeing wages clearly going up in nominal terms faster than, not as fast as prices. I think back in the 70s, there were a lot of cost of living adjustment clauses in union contracts, and unions were pretty powerful. And so I think rising gasoline and food prices, which were a big part of the inflation back then, went straight through into wages. This time around, we don't have we don't really have that much at all in cost of living adjustments. Dear workers were able to get one for in their contracts, but there isn't just kind of the automatic knee-jerk transmission mechanism from food and energy prices to wages. You know, the microeconomics of it, of course, is that real wages should increase along with productivity. And I'm a big believer that productivity has been picking up and will continue to pick up. So I think a lot of this is short-term. I think looking over the next year or two and beyond, I think wages are going to rise faster than prices, but I think it'll be based on productivity, not on a wage price spiral situation. Thank you, Willem. Patrick, hello. Can you please go over the rationale behind your expectation there'll be no recession this year or next year, please? Yes. Consumers are slowing down. They've satisfied a lot of pent-up demand for goods, as we saw. The auto sector is an area where we're likely to see a strong demand for autos the second half of the year, assumption being that the semiconductors will be increasingly available to produce the cars that go onto the dealer lots. Capital spending, as we saw, is absolutely booming. I think companies have come to realize that the labor shortages, especially skilled labor, is a chronic situation, and that they've got to increase the productivity of their labor force, manual and manual and mental productivity, by spending on equipment, capital equipment, and on technologies. And so, again, it's one of the reasons I remain positive on technology. I don't think it's anything like what we saw in the Y2K boom that then just kind of completely petered out. This time around, technology spending is going to remain very strong for the foreseeable future, as will overall capital spending. Housing, there's a real shortage of housing. I think we're going to see continued strength in multifamily and even single family. There's room for more inventory rebuilding, though the arithmetic gets a little weird when you have a big increase one quarter and a smaller increase the next quarter. That's a negative, and that could be an issue for the first quarter. But generally speaking, a slowdown in consumer spending offers businesses a great opportunity to rebuild their depleted inventories. So I hope that kind of covers it for you. On the fiscal side, we've got we don't have the social build back better, but we've got the infrastructure bill that is going to mean more spending by the government on public goods. Relative buy opportunity within mid caps versus large caps. Valuation disparity has widened further with the sell-off so far this year. Yeah, I mean, for the past 6 months, I'm embarrassed to say that I've been saying mid caps really look cheap relative to large caps. Benefit of hindsight. Again, maybe the mid caps are viewed as a risk-on asset that you don't want to have when the Fed's tightening. Though earnings have been on fire, as I showed you, I still think the mid caps are cheap, and maybe it's time for them to outperform. But I don't know that I have a credibility in market timing of this thing, but I do think they're cheap. And I think if you'll give me a few more months for these things to work, I think they will. S&P 600 is at 13.6. I guess you're talking about the forward PE. This is Vincenzo. Might it be just because earnings are way above trend, and so market participants are discounting a return to trend? I mean, that's possible, but the fact is they are way above trend, and they've been extremely strong. To me, it suggests that, and looking at their profit margins, that suggests to me that small companies are able to take advantage of the technologies and innovations that are out there to increase their productivity. And that's another possibility, by the way, is that investors feel that large cap companies have a better advantage in finding workers and keeping them. The small cap companies, that's another possible issue there. But the earnings have been great, suggesting that despite labor shortages, rising labor costs and all that, they've been able to generate great earnings. So I'm not particularly concerned that we're going to go back to trend. Is the forward PE ratio for S&P 600 correct? S&P 600 report Ratio is 15.8. I'm pretty sure it is. I'll look at it, and if it's not, I'll write it up. But you're saying, okay, I'll look at it, and you're referring to one of our reports. It may be weekly versus daily data. So I'll look at that. Some of our charts are weekly for the PE, and then we're impatient. We want to see what's really going on, and there is no such thing as daily forward earnings. So we just take the weekly forward earnings and divvy it up, spread it out over the days of the week, and then look at the price, and that's how we calculate daily. So I suspect that's the big difference between what you're seeing as 15.8 for the small caps and the number we just talked about being 13.6 for the S&P 600. I'll take a couple more questions. At which point do you expect Fed funds QE to materially impact the cycle? I think it in terms of the business cycle, I think in some ways it's doing it in a positive way now. I like the fact that a lot of air is coming out of speculative bubbles, like the SPACs, like the meme stocks, like the ARK stocks, without having any real implications for a credit crunch in the economy or the economy itself. So in some ways, the Fed has accomplished quite a lot just by talking about what they're going to do. And maybe as a result, they're not going to have to do as much. But on the other hand, they are creating a lot of uncertainty. And there clearly is a huge debate about just how far behind the inflation curve they are and the extent to which they have to catch up with it, and the extent to which the recent bout of inflation isn't all monetary, but has to do with some other factors. This is from a fellow by the name of Mr. B. Thank you for taking my question. Tights one. That's a lot of questions, but let me take one. Tight spreads in the U.S. high yield corporate bonds. To what degree do you think the Fed's buying up junk ETFs is particularly keeping high? I don't think they're doing that. They said that they were going to support the market back in March 23, but to my knowledge, they haven't bought any corporates. I think they did a few way back in the spring of 2020, but Blackrock was basically told, forget about it. Just telling the markets we're going to back it up seems to have stabilized the corporate bond market. So I don't see that really as an issue. What is your view that China's zero COVID policy, U.S. tariffs causing supply chains and moving to, the zero policy in China is clearly depressing China's economy. And it has clearly the potential, and is already in some areas disrupting supply chains again. So that could be a source of frustration for my view that the supply chain disruptions start to loosen up by the second half of the year, and that also helps to bring inflation down. I mean, clearly we need the semiconductors to produce the cars, though I can't imagine that used car prices are going to continue to go up at a 50% year-over-year rate, or that even new car prices are going to go up 12% year-over-year. We're over time, but let me take one more here. Peter, how far can Fed get rates up before they tip over the economy? In 2018, it was 2.5%. I think that's right. I think that's probably about the right level at which they could get the Fed funds rate. We're looking for the Fed funds rate to get to 1% by the end of this year, 2% by the end of next year, and well, ask me again in these webinars. But we could get to 2.5, I guess. The yield curve is what we need to watch, and the yield curve is suggesting that the Fed may not have to raise rates much to really slow things down, including inflation. Finally, I'll take this from Bruce. Today, FT interview with Norwegian National Fund said we will have much tougher times ahead with extremely low interest rates and a very high stock market, and with increasing and in some places accelerating inflation. We could see a long period of time with low returns. Oh, so the quote seems to be, low interest rates. The question is, I'm not sure that it's written quite right, but I think what you're saying is that the Norwegian National Fund manager said that we're in for a period of chronically high inflation, and that will be troublesome for the financial markets. That's his view. My view is that the four forces of deflation are still out there. Globalization isn't completely dead. The technology disruptions continue, and they're fundamentally deflationary. Demography is inherently deflationary. And then debt, there's too much of it, and that's deflationary. So I think some of these inflationary pressures are supply chain related. Some of them are clearly excess stimulus from monetary and fiscal policy. A lot of it really is on the fiscal side with those checks that were sent out and were monetized by the Fed. But we're not going to get any more rounds of checks as far as I can tell. And the Fed's moving towards tightening. So I think inflation isn't going to be as big a problem as this Norwegian fellow is thinking. And a big difference between the 2020s and the 1970s, which is a scenario that he seems to be implying, is productivity collapsed during the 1970s, and productivity is already in an upward trend. The growth of productivity is already on an upward trend. Well, we kept this going for another 5 minutes beyond what I try to keep this down to 30 minutes to respect your time. Thanks, everybody. We had a nice turnout. Thanks, everybody, for joining me today. And let's do this again next week. All the best. Have a good week.